Do you want to do a smart thing in 2022? Well, maxing out your retirement plan potentially is one of them. Yeah, it's smart and very, very beneficial to strive to put in the maximum amount into your retirement accounts pretty much every year. Why? You get one, increased savings for retirement, plus two, it reduces your tax burden. Hey there, my name is Kenner French. I'm with vastsolutionsgroup.com. We do tax, finance, and artificial intelligence to lower tax liability for business owners, entrepreneurs, etc., etc. I run the company. I'm here to help you in this episode where we're going to be talking about maxing out your retirement plan in 2022. You got to take advantage of these strategies to make the most of your retirement accounts. Let's talk about those specifics. Number one, catch-up contributions. If you're 50 and older, you can make additional contributions to your IRA or qualified plan, that being a 401k as an example. You can contribute an additional $6,500 on top of the current maximum, let's say for a 401k as an example, of $20,500 to qualified plans. For IRAs, individual retirement accounts, you can contribute an additional $1,000, so $6,500 plus $1,000. I should say 6,000 plus 1,000. Roth conversions, in many situations, you can convert or you can benefit to convert a portion of your traditional IRA or other plan to a Roth IRA before December 31st. Again, Roth conversions sometimes make a lot of sense, really depending on the circumstances. And you should talk to your individual tax advisor or financial advisor to see if a Roth conversion works. So let's talk about, with a Roth IRA, you pay regular income tax on the funds before you put them in. Okay, but once they're in, let's say in a Roth IRA, they grow income tax free and you pay no income tax when you withdraw the money, as long as you're abiding by all the IRS rules, etc. So that's nice. Now, plus, unlike your traditional IRA, you're not required to ever withdraw the money if you don't want to. It's called a RMD, a required minimum distribution, where you have to pull out the money right now when you're about age 72. So they can contribute to grow tax-free as long as you like. So that's really, really nice, right? Now, you can even pass them down tax-free to your heirs. So the potential value of your funds in a Roth IRA is much greater potentially than the potential value of an IRA fund. Now, if your current taxable income has some room for growth because your tax deductions and credit, they're wiping out your taxes, then the additional taxes for rolling over the traditional IRA might be a non-issue for you. It might not matter then. Also, if you expect to be in a higher tax bracket when you retire, which might be the case depending, you'll pay fewer taxes on your rollover now than you would if you kept the old IRA and had to pay taxes on distributions in retirement. So again, just look at the thought of a Roth conversion of your IRA. It might make a lot of sense, but you got to talk to your advisor. Or if you're adept enough, do it yourself, which is rare, by the way. Also, start a self-employed retirement plan. If you're self-employed, let's say you don't have any employees, and you're currently not utilizing your retirement plan, you can potentially contribute almost, around $61,000 towards your retirement each year in what's called a defined contribution plan. So it's a 401k combined also with a profit sharing plan or a match, depending on the circumstances. Not only are you planning for your retirement, but you're also reducing your taxable income by quite a bit. There are a lot of options available for retirement plans. Now, specifically for those who are self-employed, Uni-Ks, sometimes they call them, or max 401ks, depending on the circumstance. Investigate your options because it will help you. Now, play the calendar game. This is it's a unique strategy that a lot of people don't employ that they should. If you find yourself nearing the end of the year, end of the calendar year, and you potentially see that you're not going to reach your contribution limits for your 401k, do what you can to increase your payroll deductions, even if it's just for a few months, even if it's November, December. The same goes for IRA contributions. Do what you can to reach the limits, because again, helps your retirement savings, plus it potentially can lower your tax liability. Now, keep in mind that every $1,000 you put into your 401k or other plan, it's worth almost $6,000 in 20 years, depending on the management of it, and approximately $14,000 in 30 years at, let's just say 8.5% interest. Obviously, no guarantees are offered by me or any of the entities that I work with. Now, tighten your belt for a couple of months, let's say November, December, it'll pay off in the end. Maximize your contributions any way you can. Contributions to retirement plans often offer tremendous flexibility as they relate to tax planning. Now, These strategies can improve your financial situation. It's important to do the necessary research before making significant changes to your retirement plan. Just as there are, with many things to reduce your tax burden, there are many mistakes that can increase your tax burden as well. So, as I said before, consult with your consult with your tax advisor, consult with who knows your attorney. Working together with these professionals, you can take advantage of these strategies and hopefully make more money in the long run. Now, once again, my name is Kenneth French, business contributor with Forbes.com, run VastSolutionsGroup.com, and also Vast Holdings Group, and I do some speaking around the world. So if you need any help, potentially, look us up, VastSolutionsGroup.com. Again, VastSolutionsGroup.com. Once again, my name is Kenneth French. Hopefully, I've done my little part in helping you increase your retirement savings and lower your tax liability.